All right, Cheryl, thanks very much. Dow Industrials up 425 points on this news. Joining me right now to break it all down is Mark Mobius, a former CBO director and American Action Forum president, Douglas Holtz-Eakin, Georgia Congressman Buddy Carter, and joining the conversation all morning long this morning, Mark Tepper and Liz Peek. Mark Mobius, just to close out the loop, we got the numbers now. Your reaction?
I think they look fairly good, but we're not out of the woods, let's put it that way. I think oil prices could come back up again, and that could pull the CPI up. But of course, the Fed is very eager not to raise rates for political reasons, but they may be forced to do so.
And we wonder if, Doug Holtz-Eakin, this means the Fed can actually go to a smaller hike. Yes, we know that the Fed will likely continue raising rates, but 75 to 50 basis points is the betting on Wall Street. Your thoughts?
They foreshadowed a 50 basis point increase in December. I don't think this moves that at all. This feels a lot to me like the CPI release, where the market reacted strongly to what I viewed as really not a big change in the plateau, high level of inflation that we're experiencing. This is a modestly good report, especially the core. But, you know, we're at almost 7% inflation. That's a long way from 2%, and no reason for the Fed to change course. I think people need to just take a deep breath and expect more of the same.
Yeah, I mean, Congressman Buddy Carter, this was an issue that you all in the GOP ran on, the fact that inflation is at 40-year highs. We're off of the highs, but nonetheless, you're talking about pretty significant levels of 8% in producer price indexes year over year.
Absolutely, and I don't think we can be satisfied until we get back to the numbers that were present in January of 2021 when this administration took office. I mean, you know, you can celebrate all you want. Oh, it looks like it's trending down. Yeah, that's because it's been so high. And yes, that is progress, and I'm glad that we're seeing progress in that respect. But at the same time, these numbers are so much higher than they were when this administration took office, and that's what we have to keep in mind. And I'm glad the stock market is running up, but my people, my constituents, they're concerned about the supermarket, not the stock market. That's what they're concerned about milk and eggs and gas prices. That's what they're concerned about.
Yeah, and Mark Tepper, a dozen eggs was up 43% year over year, as per the last CPI number last week. Butter up 28%. All the essentials in food continue at pretty high levels.
Yeah, and as we mentioned, I mean, when you look at consumer inflation, that's disproportionately impacting lower and middle income families versus, you know, higher income families, without a doubt. Look, when I look at this PPI print, though, I mean, look, let's be honest here. It was a good number, right? It came in a heck of a lot better than expected. But let's not also forget that when we look at consumer spending is shifting away from goods because we bought so many goods from 2020 through the middle of 2022. There's now this pent-up demand to spend on services, whether it's airfare, hotels, whatever it may be. So we're seeing consumer preferences on spending shift. And as I mentioned earlier in the show, the Fed is going to be concerned first and foremost with sticky inflation. The market tends to react to these, you know, month-to-month lumpy readings. But at the end of the day, that's not what's going to change the Fed's course. The Fed is not going to change course until they see that sticky inflation is under control. And I just don't think we're there yet.
I'm just wondering, Liz Peek, if we're seeing some good numbers here toward year-end, expectations of an okay holiday season, but things reverse in 2023 with all of the impact of higher prices relative to folks' wages.
Yeah, I think there's some chance of that, Maria, but I also think we're going to be looking at very different core issues in 2023. I think we're going to be looking at job losses and the impact that we are going to be experiencing from 4 very big rate hikes out of the Fed and another one to come. It may not be 75 basis points, but 50 basis points is still big medicine. One of our guests earlier talked about the lag. The lag means it's going to start showing up in 2023. So I think inflation has sort of plateaued. A lot of economists have been pointing to things like rent stabilizing, or the rate of increase stabilizing, I should say, and other issues that make me think it's going to be 6-7% for quite a while here. The issue is now, what happens to the economy as we go into the new year?
Yeah, exactly. The Fed's next meeting, December 13th and 14th. I know Cheryl has more info on the PPI report. Over to you, Cheryl.
Well, I want to bring in the revisions because they actually revised the month of September lower. So initially, the month-to-month for September was a 0.4. They just took that down to a 0.2. They also revised lower the annual read for headline PPI for September. It's now 8.4. It was 8.5 initially. And then again, the core month-to-month, they revised that as well down to 0.2. So if you want to dig into these numbers more and more and kind of see what we can read from the tea leaves, we're seeing revisions now lower for September. I'm also looking at headlines crossing from Walmart. Liz Peek was talking about inflation. Buddy Carter's talking about his constituents. The chief financial officer of Walmart just a few moments ago said that they are planning their business around the story of elevated inflation. They are making plans for 2023 on the basis that they're going to be facing, and their customers are going to be facing, higher inflation. And that is a story at Walmart, and that really goes to, I think, the breadth of the American consumer. And in particular, they're talking about grocery inflation, Maria, which you were just talking about egg prices. The CFO was saying our business was good for the grocery component of Walmart. That's because these prices are higher. So it's a good, bad news story here.
Doug Holtz-Eakin, what do you look at in terms of the big story for 2023 economically? As the Federal Reserve raises interest rates, it's becoming more expensive, obviously, to carry the debt that you have been studying for so long, $31 trillion.
Yeah. Well, I just want to pick up first on something that Mark said, which is, 2021 was the year of goods price inflation. This year, it's services. And the poster child for this is the shelter component of the CPI, which is up 6.9% year over year and has yet to plateau. It has risen every month since January of 2021. So what you're going to see in 2023 is the Fed continuing to lean until it sees the services components come under control and start to trend down. And as it does that, it is going to run the risk of doing too much, and there's a really heightened probability of recession in mid to late 2023. And B, as they raise those rates, as you mentioned, you're raising the borrowing costs, and we're soon going to see the federal government spending more on interest than on the Pentagon budget, for example, which is just shocking, and which tells you that the underlying finances, the size of the government, are too big, and that's the #1 job for the next Congress.
Mark, what about that? How does all of this change the equation in terms of investing? We've got a rally in bonds that has been underway for the last few days. Yields now back below 4% to 3.7%. Do these economic data points change anything about allocating your capital in 2023?
Well, look, I mean, as far as
not really.
Go ahead, Mark Mobius.
Sorry. No, sorry. No, it really doesn't change anything, because at the end of the day, if you're expecting higher rates, which we are, bonds are not a place to be unless you're very, very short-term bonds. And where you should be is in equities, in companies that have pricing power, that are going to be able to raise their prices higher than the inflation level, and companies that have no debt or very little debt, because debts are going to be the killer for many companies. I think we're going to see many bankruptcies as a result of these higher rates. So it's still equities at the end of the day.
I say. And you've talked a lot about India this morning, that's really one of the growth stories. I assume that's where you're also placing capital.
Exactly. India is the place to be, and Taiwan. Despite all the threats from China, Taiwan companies are doing very well. Semiconductors are doing very well. At the end of the day, that's the place to be, as well as India.
Yeah, by the way, we should point out that Berkshire Hathaway has invested taken a stake in Taiwan Semiconductor. And that stock this morning is up about 10% in the pre-market. One of the big movers on the upside of the morning. Taiwan Semiconductor is one to look at. Congressman Buddy Carter, you want to jump in? Go ahead.
I do. Let me tell you, I thought Liz made a great point about jobs, and that's going to be important. We know Amazon is going to be laying off 10,000 workers. Well, that's going to have an impact on small businesses as well. When you see the large companies make those kind of cuts, then you can expect it with small businesses. And when you're talking about small businesses, you're talking about the lifeblood of America here. I can tell you, as a small businessman for over 32 years, what happens ahead of us, it is very, very very important. And when small businesses are impacted, as they have been through this high inflation, 51% of all small businesses have had to make cuts or had to take out a second loan. That is going to hurt, and that's going to tell on the American public.
So what can you do about it? You want to talk a bit about what went on in the midterms this week, Congressman, and what kind of leverage you're going to have now in the new Congress?
Well, we're certainly going to, it's important for us to unite. There's no question about that. We've got an opportunity here to govern. And if we unite and we govern, then we can build on our majority. Yes, we're disappointed. There's no question about that. I think everyone's disappointed in the results. But there were a lot of good results as well. We did exceptionally well in Georgia. Glad to see our governor reelected as he should be. Florida did exceptionally well. We flipped 4 seats in New York. Looks like California's going to do well. So there's a lot of good out there in these elections. Yes, we're disappointed. We thought we were going to see more than what we've seen, but at the same time, this is a tremendous opportunity for us. We coalesced around the commitment to America, and now we've got to fulfill those promises.
Mark Tepper, jump in.
Regardless of the month-to-month lumpiness of this data, the most important thing that investors need to realize right now is that we are transitioning from a long period, 13 years or so, of quantitative easing from 2008 through 2021. And we are now entering this period of quantitative tightening. And during the QE years, we really saw a rising tide lift all boats. Passive management worked just fine. Companies that weren't making any money had $50 billion valuations. Analysts were talking about TAM, total addressable market. I don't hear anyone talking about TAM anymore. Now they want to know if the company's actually making money. Are they generating earnings, cash flow? TAM was kind of code for we need to justify a $50 billion valuation because they don't make any money. So I think what you're going to see happen over the course of the next few years from an investment standpoint is active management is going to be important again. Your stock pickers are going to be in favor. And as Mark mentioned, those companies that are short duration, generating cash flows, high quality companies, I think that's where you want to be over the course of the next several years.
Liz Peek, how do you see it?
Well, I think that's exactly right. And something I've been talking about for 2 years since we started to see inflation really come on the scene is that there are companies that can really price their products, and there are a lot of companies that cannot. If you have a proprietary product or service, you can get through inflation pretty unscathed. And in the beginning, it looked like tech was in that position. But tech just got overblown because of the COVID experience, and now it's sort of reeling that in. But, I think it's going to be a stock picker's market. I think that's completely right.
This market is taking off. Look at Walmart up 7.5%. Look at Taiwan Semiconductor on the Berkshire Hathaway stake up 11% right now. And we're watching an inflation number impact markets positively as well. Cheryl has more. Over to you, Cheryl.
Well, as we're looking at all these market moves, you were talking about emerging markets overseas. UBS just releasing a note a few moments ago talking about emerging market growth for 2023. They're seeing an 8 to 13% jump for emerging markets. To your point about Berkshire Hathaway and Taiwan Semiconductor, where is the money going to be made? Where does the money need to go for 2023? And UBS is pointing to the overseas emerging market story. So I think that's very interesting as well. I also want to add, we've got a little bit of an addendum to the New York Fed Manufacturing Survey, and that their short-term outlook is actually negative. So while we've got a nice pop today from that particular data read, and that's another reason that the market's actually took off between that and PPI, want to add the short-term outlook for the New York area for manufacturing. The short-term outlook is actually somewhat negative. So that data may switch on us next month, Maria.
Mark, you're talking about emerging markets all the time. This is where you play and where you have found so many investing opportunities. Have you soured somewhat on China, given the issues we are talking about all the time with regard to bad behavior on the global stage from the CCP?
Yes, I have soured to some degree on China. We still have a holding in Hong Kong. As I said, we're big in Taiwan. But generally speaking, we're worried about China because of the threats to Taiwan and the general environment. You just never know. We may have another Russia on our hands, where you can never get the money out. So this is a real issue. Now, I know many people don't agree with me. They believe that you've got to be in China But I don't think you have to be in China. There's so many other places around the emerging markets world. You know, we're in Brazil, we're in South Africa, we're in Turkey, we're in Taiwan, and all other, and of course, India has been a tremendous performer. So you can still find terrific bargains in other countries around the world. You don't have to be in China.
It's a great point, and I'm glad you made it, because it's hard to imagine getting your money out of a place where it's totally authoritarian. And that's what we've seen in Hong Kong with the CCP throwing down their new laws, security laws, and throwing freedom fighters like Jimmy Lai into jail. Doug Holtaken, your thoughts on the economic headlines of the year ahead now that we do see actually inflation moving, the Federal Reserve raising interest rates enough to actually move the needle on inflation. Is it long-standing, though? I mean, have we seen the worst? Have we seen the peak?
I think we've seen the peak in overall inflation, but the improvements we are getting right now are improvements in goods. And we still haven't addressed the underlying trend in services. That will be the Fed's job in 2023. And, you know, when you get inflation from, say, 8 down to 4, then the hard work begins. How do you get to 2? You know, they talk about sustained anti-inflation policies, having rates at a place where they're slowing the economy for a long period of time and acknowledging it will cause pain for households and businesses. 2023 is all about how much pain will be inflicted and whether we end up in a recession. And I think that is the big concern.
Yeah, Liz, I mean, the Fed was very clear, wants to get inflation back to its 2% target. That's not going to be easy given where we are right now. And even though we are looking at an impact to inflation, are we going to see continued rate hikes throughout 2023? Certainly the expectations call for rate hikes, even if they're 25 or 50 basis points throughout March, through March.
You know, I think we're going to be looking at the Fed in a little different scenario in 2023. Yes, everyone's going to be focused on inflation. By the way, I'm very concerned that 2% target goes away as we approach a presidential election. But anyway, I think this empire manufacturing number should give us all pause, because really what we're seeing is that inventories were a big driver of production and manufacturing for the past year. Inventories, from what I gather, in almost every sector now are pretty much in balance. You take that and you combine it with the fact that consumers have lost trillions of dollars in the housing market and the stock market. All these factors lead me to think, again, that demand is really going to be pulling back in 2023. And I just think we're going to be talking about the Fed not wanting to just crush the economy. Because, you know, Maria, the other thing that's happening that we never talk about is that the balance sheet of the Fed is shrinking pretty dramatically. And that also is going to have a big lagged impact next year. This all comes home to roost.
Oh, yeah. No, it's taken $1 trillion out of liquidity out of this market, and it will likely be disruptive. But Buddy Carter, now that we're looking at a smaller majority for the GOP, what can you do about it? Can you stop reckless spending?
Oh, yes, and we will. That is one of our primary goals, is to stop the spending, because, look, inflation is nothing more than too few dollars chasing after too many goods. I mean, that's what we're talking about with inflation. And who does it impact the most? It impacts the people who are on the fixed income the most. It impacts those who are on the lower end of the scale. That's who it impacts the most. But let me tell you, I appreciate the comments here about the Fed and the way they respond. We know that they were too late to the dance, that they waited too long before they started raising interest rates. Now let's see how they respond after they've got interest rates raised and inflation starts to go down. Did they stay too long at the dance, or do they adjust the interest rates? And don't forget about the impact that these interest rates, that these high interest rates are having on our national debt, on the interest on our debt. That is one thing that people just, and members of Congress, my colleagues, I have trouble getting them to pay attention to this. The interest on our debt now, the 4th highest line item in our budget. It is killing us. Think of all the good that we could do with that money if we did not have to pay the interest on that debt.
Liz.
I'm curious what you think is going to happen with raising the debt ceiling. There's a lot to be done by Congress. If we have just a vote or two majority in the House, and I surely hope we have a majority in the House, what do you think will be the attitude towards raising the debt ceiling?
Well, I think one of the first things that we'll do is to say that we're going to stop the spending. That is going to be something that Republicans are going to demand and that we're going to insist on, is that we have to stop this reckless spending of this administration. This administration is spending billions of dollars every day, and that has got to stop. We've got to stop the spending. We've got to stop the regulatory process. These regulations that are killing our economy and killing our businesses, prohibiting them from expanding and from increasing our economy. That's what's so vitally important. And also, we've got to be pro-growth and pro-jobs and pro-work. That is the main thing.
Thank you.
Mark Mobius, how much of this is priced into the market, do you think, in terms of 2023 market performance?
I don't think it's yet priced in. I think some of the points that just have been raised are very important when we look to next year, because you may see a situation where people just can't spend anymore. They can't afford it. And you see consumer spending going down, and that impacting prices, of course. So we could have a very bad market as a result of that. So this is something to watch very, very carefully.
Layer on top of that, this FTX disaster. Your thoughts on the amount of creditors now? 1 million plus creditors now, according to this latest filing. What does that mean in terms of how this plays out, Mark?
Well, what's so shocking is the number of institutions that put money into this company. I mean, you have Ontario Teachers Pension Fund in Canada putting hundreds of millions in this company. It's just unfathomable. It's just incredible how these people put money into something which they didn't really look at closely. So a lot of people are going to be hurt indirectly, because don't forget now, these pension funds and these state funds are going to have to make up for what they lost. And they are, of course, using this money to help others. They won't have the money. So I think this crypto disaster is having repercussions around the world. And I think a lot of people don't realize how popular crypto has been, and how many people have crypto, and how many people are going to feel poorer as a result of Bitcoin and these other currencies going down.
Yeah, which is why I asked you earlier if there was a contagion effect, Mark Tepper. I mean, look, the point that I've been making around FTX is when you are facing financial stress, you sell what you can sell. And when you're talking about all of those people who are invested here, as Mark is talking about, even smaller investors owning Bitcoin, having seen all of those gains evaporate, you sell what you can sell. So what's the potential for a contagion here that forces people to sell plain vanilla stocks because they need to raise capital because of their losses on FTX?
Yeah, I mean, there's certainly the possibility of one heck of a ripple effect here, because yeah, you're right. I mean, when you need money, you have to go somewhere to get it. If you need to clear up margin debt, you need to sell something to clear up margin debt. So the contagion, it could be widespread. I don't think we're going to know immediately. Obviously, this was one heck of a disaster. Looks like it could have been a Ponzi scheme. Who knows what was going on there? But, you know, one of the biggest things I'm seeing right now across the stock market is you really have like this tale of two economies where you've got, you know, mass tech layoffs, mass retail layoffs like Amazon. But then you look at the services side. Marriott, I'm not hearing about layoffs there. Delta Airlines, I'm not hearing about layoffs there. Darden Restaurants, I'm not hearing about layoffs there. So consumers are still spending on services. However, Maria, we've spoken about this in the past. Home builder sentiment. There's typically a very high correlation between home builder sentiment and the unemployment rate 12 months down the road. If that correlation holds true, we'd be looking at a 7% unemployment rate 12 months from today. We talked in the past about the 3-month 10-year being inverted and that signaling a recession within 6 months. If all of these things transpire, as they should, we are looking at a recession whereby consumers will be tightening their belt buckle on services at some point in the middle of next year.
Well, look what Cheryl reported earlier from the CEO of Walmart. Regardless of income levels, families are more price conscious right now. CEO says companies' private brand penetration in food categories increased. We observed incremental trade down in categories. So, Liz Peek, people are finding alternatives, trying to operate as best as they can when they're faced with double-digit increases in essentials.
Yeah, and let's not forget the real wages are still lagging these inflation numbers. I mean, the truth is inflation, the PPI number was up 8%. Just because all the experts, air quotes, said 8.3% does not make 8% a good number. So people are hurting. Their standard of living is going down. I also would just say one thing, Maria. I think it's an interesting generational thing that's happening right now. Who really was completely dove into Bitcoin and FTX and stuff? Younger people. And younger people just got slammed on their holdings of Bitcoin and other currencies. And also tech. I mean, who's getting laid off? Tech people. I have young people I know who just lost their jobs. They can't believe it because that was something that was completely outside their vocabulary of experience. So I'm afraid, it's going to be people under 40 who are going to be particularly slammed by what's going on right now.
Yeah, it's a great point. Amazon is expected to announce layoffs. And of course, we have also heard a number of tech companies do so. CFO of Walmart, we've seen incremental levels of inflation month over month be less significant, but it's not clear if this represents a sustainable trend from Walmart, despite the better than expected numbers coming out of retail this morning. It's been a great conversation, everybody. Thank you so much. Mark Mobius, Doug Holtz-Eakin, Congressman Buddy Carter, Mark Tepper, Liz Peek, Cheryl Casoni. Great hour on retail and inflation. Have a great day, everybody. We'll see you again tomorrow. Morning Company begins right now. Stu, take it away.